right, guys. Hello, and thank you for joining us. My name is Ryan McArdle, and I'm a partner at the Palomar Group, a full-service investment sales firm based in Augusta, Georgia. And I'll be hosting the call today, along with my partners, Steve Collins and David Rivers. To kick off the new year, we wanted to host a follow-up call to our market update call that we had in early March of last year, when the effects of the pandemic were initially taking hold on our industry. We wanted to get a temperature check straight from the source on how the industry has been able to adjust over the past 8-9 months and what industry experts think that the year ahead will look like. Today on the call, we're happy to have some industry veterans from some of the country's largest and most active real estate firms, including Dave Wick from Phillips, Edison and Company, Mark Horgan from Brixmor, Ryan Cockerill from Agree Realty, Jim Halliwell from Principal Financial, and Michael Deering from Hutton. Gentlemen, thank you all for agreeing to be a part of our call today. Let me start by giving our best wishes to those on the call for a happy and healthy new year. We're hopeful that you and your loved ones have remained healthy over the course of the past year, and that your companies have found creative ways to continue moving forward in the face of these unprecedented times. The Palomar Group continues to be open for business and is committed to helping our clients in any way we can. While this year presented the obvious challenges, the Palomar Group was fortunate through a ton of hard work by our team to finish the year strong with a record number of transactions, and we are encouraged with what the market holds looking into the first part of 2021. With all that said, we'll jump right into it. The first thing that we wanted to get into was to see if we could get a little recap since we last spoke in March of the last year, and see how your respective companies have been able to achieve results, find success through the unprecedented times that we've been through. At Palomar, when March hit, we saw a number of deals fall out of contract with a huge amount of uncertainty as to when they would come back. When August hit, we saw buyers and sellers coming back to the table, and a significant uptick in the transactions that were able to get done to finish out the year. I'll open things up with Dave Wick of Phillips Edison. Dave, how did the third and fourth quarters play out at Phillips Edison?
Well, first of all, Happy New Year to you guys, and thanks for including me in this. I think when you said veterans and experts, I assumed that I was one of the veterans and not one of the experts. But either way, I'm proud to be a part of this this call. And to me, it seems like it's certainly been a lot longer than 8 months since we last did this. Feels more like 2 years. But you know, I think we talked a little bit about back in March that our transaction team, we really stepped into asset management mode, and I think our whole company really stepped into damage control mode, thinking that things were about to get really, really ugly. And as you guys know, our portfolio is mostly grocery anchored, mostly suburban, and as it turns out, it didn't really get all that ugly. I mean, those assets held up pretty well. So while we were pretty focused on our transaction team was pretty focused on handling rent deferrals for national tenants for the first couple months of the pandemic. Really, the second half of the year, we were looking for opportunity, probably like everybody else on this call. You know, whenever there's disruption, there is ultimately opportunity, and we've been in 10 years of record economic expansion, and just started looking for opportunities. And so from a transaction standpoint, we closed on a couple acquisitions in the second half of the year, a couple grocery anchored assets, and we actually ended up selling about a dozen deals last year. And I think you guys obviously were a part of a couple of those, and we're just being opportunistic on the buy side and on the sell side, and felt like transactions started to happen again in the second half of the year. Not easy. It wasn't easy to get into the finish line, but we were able to get some done.
Great, thanks, Dave. Mark, I'll throw things to you. How things end up at Brixmor over the last couple quarters?
Yeah, and also say Happy New Year and thanks for having me. I think I would echo what David just said. we had, when we got to March, it felt like you were staring into the abyss, and we really did focus a lot of the company on what we thought was going to be a really tough time. And we did spend a lot of time negotiating some rent deferrals with national tenants and, working with the small shop for PPP loans and things like that. But ultimately, we've gotten rent collections back up towards the top of the REIT group, which we're pleased with. And I do think it's part of it's the platform we have. Part of it's the asset type that we're invested in. Just like Phillips says, we have a lot of suburban assets, a lot of grocery anchor deals, and those assets have generally performed well through the pandemic. From a transactions perspective, when we started the year, we actually had a pretty fulsome pipeline of acquisitions that were basically match funded with dispositions. And we feel pretty good about not getting stuck on any acquisitions, because we do feel like as we've gotten towards the end of the year, we're seeing just better opportunities to put money to work. We're also an opportunistic investor on the acquisition side. And we're seeing deals come back to us that we looked at a year ago at 15-20% cheaper than they were a year or so ago. That are starting to make a lot more sense from a basis perspective as we're looking at putting money to work. I mean, our biggest fear as we look at the market today is really just trying to figure out that health of the small shop, and that's really where the tug and pull is as we're looking at acquisitions. From a disposition side, we did sell some small grocery anchor deals, but the one part of the market that we saw to be very active was the net lease space. And so we've been looking at some of the non-core assets and selling some ground leases in some of our non-core assets at pricing that's well inside of where we're getting indications from brokers on where the assets are worth. So we've been spending time setting up that program to just monetize non-core assets by cutting them up and getting cap rates that are 300, 400, or 500 basis points inside of where brokers are telling us we could sell the full center. So kind of an interesting trend for our company as we've looked at how to fund our business going into 2021.
Thanks, Mark. Ryan, on the single tenant side, how the second half of last year finished up for you guys?
Yeah, it's funny. I was looking back at some of my my notes I jotted down. I think I described the environment as growth to preservation overnight. I think everybody was making their calculations on how the remainder of the year was going to pencil out as far as where rent was coming from, how to fund deals, et cetera. I think we, fortunately had pretty solid collections. As of late, we've been, I think, at 99% the last 4 months. And we actually released some data on our 2020 activity, so I can speak to that high level. But we actually had a record Q2. I think it was around $270 million or so, and then topped that off with a $450+ million quarter in Q3, and another strong quarter in Q4. So at the time, I think when we connected in March, we maybe had $200 million out the door, and at the end of the year, we ended with just over $1.3 billion. So, like I said, fortunately, we were in a position where we had the ability to raise capital, both on the equity and debt side, and saw, I would say, an opportunity definitely in the end of Q2 and into Q3, where there maybe wasn't as much institutional players in the game. I think we took advantage of that opportunity, but ultimately, I think the uncertainty led to a lot of sellers. Again, we're doing deals with some of the largest owners out there, but also a lot of one-off single tenant net lease deals where the certainty of execution on an all-cash deal was valuable to them, and we took advantage of that landscape.
Yeah. Well, that's great. Thanks, Ryan. Jim, Ryan mentioned, in his world, a lot of the institutional players not really being active the second half of last year. What did you guys see on y'all's end, come August through the end of the year? Did you all stay on the sidelines, or were you all active at all?
Yeah, I would say, Ryan, in the fund world, which our largest vehicles are open-ended funds, the institutional investor demand is pretty tepid. And I'll just give you some general parameters. Our open-ended fund, the open-ended fund index is something called Odyssey, the open-ended core diversified index. And there's 24 plus or minus 24 members in that. And let's say the retail percentage is in the high teens, maybe 17, 18. we've fared well because we're more in the 14 and 15% range and have no mall exposure. Now, the Odyssey has a lot of mall exposure with a lot of the participants. So we've been on the winning side. I don't know where retail will go in the institutional fund world, but a lot of predictions are most participants probably want to manage that down to the 10 to 12% range. So if the whole index is, you know, in the upper teens, I think it's going to be pretty dormant until that shrinks into the 10, 12% range. And so we would look at a retail transaction in a very granular way. Let's say an $11 billion fund, which is our gross value of our large fund. I mean, if we bought a $40 million deal, it really wouldn't move the needle much on our retail. But I would say we're probably similar to most, which is more in a reduction mode and a very opportunistic mode. And I think most, and this is in the fund world, I think most of them will be in a net shrink mode until that gets to about the 10 to 12% range. And I'd be interested if that's what others are hearing from participants like myself.
Yeah, no, I appreciate that, Jim. We'll open that up as well. Mike, let's lastly, let's get some quick feedback from you. You know, obviously on this call, you come from a little bit different world right now at Hutton, being an owner and developer, you know, where you're buying and selling deals, but also building ground up deals a lot. How the second half of last year end up treating you all at Hutton?
Yeah, thanks, Ryan. Thanks very much for having me, and Happy New Year to everybody. The second half of the year, I guess I can cover it from both angles. On the transaction side, you know, half of our asset base is comprised of single tenant net lease space. And so that held up really well. And we were really pleased with the activity we had. We were obviously pleased with some of the pricing we got as well. There seemed to be pent up demand for that type of asset class. And then, you know, on the other side, we kind of slowed things down as it relates to the multi-tenant and shopping center assets that we have, which is the other 50% of the value that we have. So all in all, we fared pretty well. Definitely shifted our plans with respect to our shopping center sales into this year, and we're kind of waiting to see how the year starts off. But all in all, pretty well there. And then on the development side, I would say it was more of the same, where we had a pretty healthy pipeline come into the year. And when March hit, like a lot of groups, we didn't know what was going to happen. We kind of expected things to get pretty bad. And while it wasn't fun, most of our pipeline held up really well on the development side. So we came in with about a $200 million pipeline, and 70% of that went along as scheduled. And there was some delays here and there, but for the most part, those projects are on schedule. The 30% that didn't just got deferred into this year. So all in all, from a total development pipeline perspective, we were pretty much right where we wanted to be, and feel pretty good about it considering the year we had. And so entering this year, you know, it's obviously a new year, and we've got another rather robust pipeline, but so far, and kind of the velocity we have, we're seeing that continue so far. So fingers crossed that's been a good sign for us so far.
Good deal. And Jim, back to you. I know that you kind of left it open, that you had a question, kind of, you wanted to get some feedback from guys. What was that again?
Just if they're hearing from fund investors like ourselves, if there's you know, a very diminished demand based on where they kind of want their portfolio to settle out from a retail allocation. And you, Ryan, you may have insight on that as well.
Yeah, and go ahead, guys, if you got any commentary there.
Yeah, I think there's really no question about that. We're seeing deals that some of the funds bought in the last 2 to 3 years come back to market. We're seeing deals where funds have debt on them and they may need to recap and put more dollars in, and they don't want to. So we're seeing a fair amount from almost all of the major, you know, names that you could think of that are in the space. It's what's interesting from our perspective is, you know, and I used to spend a lot of time in my career in the mall space. A lot of those guys who went long the malls are almost being forced to sell some of the open air assets because they're liquid and they really can't transact on the mall side. So that's really bringing, I think, some interesting assets to the market right now out of those, out of the funds.
Gotcha. Appreciate that, Mark. Well, appreciate that, guys. Thanks for the quick recap. I'll throw things over to my partner, David, as he'll throw a couple questions your way. And I know we had everybody kind of go down the line and give a quick recap of the second half of last year. But if you've got anything to add going forward, as we kind of ask some open-ended questions, feel free to chime in at your leisure.
This is David, Ryan Cockerill. You guys are looking at single tenant concepts, different retailers. There's been a lot of dialogue about which retailers are doing well, which ones are having more issues. What concepts out there today are you guys really excited about, and which ones are you guys growing a little more cautious of?
Sure. Yeah, great question, David. And I think it's pretty visible from the the companies who are reporting earnings and doing well. It's reflecting their stock price. The general merchandise retailers, the bigger boxes, the Target, the Walmarts of the world. Obviously grocery's been a strong suit during the pandemic. Home improvement, pharmacy, dollar stores. In the net lease retail world, I think those were clear leaders throughout the pandemic, and we did double down on those tenants. Over the last 3 quarters, the spaces that we saw the largest headwinds were, fitness, entertainment, restaurants, specifically casual dining. The last stat I heard, in the restaurant casual dining world was 100,000 restaurants have closed, since the pandemic kind of took hold earlier this year. So, we concepts within those respective sectors on both sides, we've kind of gravitated to or doubled down on, and then we've never really been big in those fitness, entertainment, and restaurant concepts. So if anything, we continue to stay away from those. And I would add, there's a lot of in our world, there's a lot of net lease retailers out there that are private equity sponsored or have pretty, and I'd say pretty levered balance sheets in our conservative criteria of what we'd like to have. And, if there were any of those that were on the fence, or maybe it was great real estate and a great performer, but the credit, was questionable, those were redlined, and we just didn't even think about going into, any of the inferior credits that we see out there in the last 3 quarters.
Good, great. Next question, David Wick, moving into 2021. And ideally more opportunities. Where do you see those opportunities coming from, and what are you all getting excited about for this year on that front?
Yeah, I mean, the couple deals that we ended up buying last year were grocery anchor deals in markets where we've got significant presence already, like Atlanta and Denver. And we're able to just buy them at what were, 5 to 10% discounts relative to what they were, what they would have been in February. So, I mean, I think as you guys are fully aware, being in the business that you're in, the transaction volume is definitely down. And so it seems like people that are transacting, especially on the sell side, are people that have some sort of motivation to transact. So that's been our primary focus, is try to find people that or groups that have to transact for one reason or another, and because those are the market sellers. Otherwise, we're seeing a pretty big disconnect. And again, this is only in the grocery anchored space, not in the mall space or the power center space. A pretty big disconnect between bid and ask right now. And everybody that's buying it is looking for a deal, and everybody that's selling it is thinking that it's still the top quality asset. So for us, it's that figuring out why somebody needs to sell, and really for us, it's also continuing to buy assets that are accretive to our existing portfolio in markets that we already own in, and at better returns and with better demographics, better sales, better term than the existing portfolio. So a pretty wide net, I think, but I think those opportunities will be out there this year.
Dave, and follow up to that, I'd be curious your thoughts and Mark's thoughts, especially being in a grocery anchored asset class for the large part. We always tell people why we believe, one of the reasons we believe our transaction volume was up in the last 2 quarters was that, most of our deals get done in the Southeast. And, the centers we were selling in the Southeast, by and large, were open for business. Even if that was in a reduced capacity, the restaurants were open and doing business. The hair salons and things were open, even if at 50% capacity or something. Whereas, I don't feel that obviously that wasn't the case in some places in the Northeast or out West. Do you think that that pricing disconnect was greater in those areas where tenants weren't open for business, or do you think it was pretty stabilized throughout the country in terms of that spread?
Well, I think you're dead on, and Mark, I'm sure you can speak to this as well. Yeah, because deals just weren't really getting done in those markets as a result of that. I mean, I think there was just a general fear from a seller standpoint that you'd be selling at a discount and not getting the right value for the deal, and then as a buyer you'd be fearful that you're paying too much for it, because who knows what the rent roll is going to look like if things don't start to open up. And so I think you're right. In the South, there was a little bit more continuity and stability there, so you kind of had a better idea of what the rent roll and the income stream was going to look like that you're buying. But I also think from your guys' standpoint, and a lot of the deals in the South, there were just more private buyers, and private buyers have certainly been more active in the last 8 to 9 months than institutional or quasi-institutional or fund buyers like Jim was talking about. So I think that plays a big factor in it as well. If you're not talking about institutional quality assets and you're talking about private deals, there's certainly a lot more liquidity and transaction volume there.
Yeah, I would. It's Mark. I would 100% agree. And the only thing I would add is we wanted to invest in high growth markets pre-pandemic. We want to invest in high growth markets post-pandemic, and there's lots of inbound migration into Florida, into Georgia, into Texas. So that's part of it. Part of it's money chasing the chasing demos. I also agree with Dave full-heartedly. When we've looked at some deals in the north, some of the sellers are like, well, I thought this was worth a 4.5 cap. And we're like, well, it might have been, but your rent roll doesn't look like that anymore. It's not as strong as it used to be. So there's still in some of these markets, a really big bid-ask spread, both from a cap rate and from what you're underwriting. And it's definitely easier when the tenant's open, right? You can interview them, you can understand what their business is doing. When the tenant's closed, as a buyer, you're kind of saying to yourself, why should I take on that problem and pay you for it? So that, I do think you'll see it geographically work its way through. And I do think the North, in our portfolio, we saw the Northeast close the fastest. We saw it open up the slowest. And I think that'll probably be reflective of what you see in the transactions market.
And this is Steve. Mark, let me kind of follow up on what you just said, that shift in demographics with population shifting from the Northeast down to the Southeast and even in the Southwest. Do you think that's a trend that's going to continue for the foreseeable future, or do you think that levels back out and people start returning to these to the major markets up north?
No, I absolutely believe it's a long-term trend. You'll see better growth in the markets you mentioned than you will in the markets, in some of the other markets, some of the other high tax markets. I don't think that means they're not investable. There's certainly great assets in all these markets. I just think that demographic trend is going to continue.
And Mike Deering, let me ask you. I know along those lines. I know y'all are in numerous regions with your development pipeline. Going forward in 2021 and even into 2022, has your development pipeline shifted from what you anticipated it being, back, say at the beginning of 2020? Are y'all now focusing? I know y'all already focus on the Southeast, but has that focus even become more and shifted more to that region, or are y'all still going to be pretty active in numerous states?
Yeah, we'll still be active in numerous states. We were always a little more heavily concentrated in the Southeast. So that breakdown probably won't change all that much. Where we are shifting a little bit more is kind of diversifying into other asset classes like self-storage and multifamily. So we're already, in the process of doing that over the last year or two. And just this past year, we still are always going to be primarily retail focused, but just kind of a little bit more weighting placed on those other asset classes too. So, and most of those opportunities are in the Southeast as well.
Yeah, and sounds good. And Jim, let me ask you this: what going forward? I know y'all have several office, numerous office assets and a lot of uncertainty around those. But going forward, I know things are still pretty rough right now with the number of cases, COVID cases and hospitalizations and the strain on the healthcare industry. But as we progress through this year, what do you see the rest of this year looking like? And do you think it's going to be better, going to continue to get better as we progress through this year?
Yeah, that's a good question. We have not finalized our view on, the office of the future, and work from home. We certainly believe an element of that is here to stay, particularly in big companies. Now, we haven't done all the debits and credits related to lesser density and things of that sort. So it's a tough call. We're similar to other participants on the phone where we see it fragmented on, the suburban multifamily assets are just doing so much better than the urban multifamily assets. We think that trend is going to continue, and to some degree that's happening in the office. So our view is it is more the bifurcation between the winners and the losers over the near term is going to be pretty wide. And so in both product type, in both location, in both urban versus suburban, and, we're similar to the other panelists. We're getting into more niche sectors, data centers, manufactured housing. We've been in student housing, and that there's just going to be more of that and less of the traditional sectors. So I don't have a great answer for what happens with office, particularly urban office, because there's so many unknowns. And then the other thing, just and this may or may not be interesting to people on the calls, but along with urban office, the tangential business of first floor retail, typically sit down restaurants, which are getting crushed, parking income, which could be as high as $5 a foot. So, those sectors are getting hit on a lot of different angles. So it's a little too early to tell. Listen, as we own many, we hope that it's temporary. We hope that, the trend to collaboration and the desire to be with your coworkers gets reinstated in a similar fashion, but it really is too early to tell and make any concrete predictions. But in the near term, we're just kind of going to do our investments into the more demographically and driven sectors and areas where we think there's better landlord pricing power.
Great.
Good feedback. Go Who's. In general, we've had everybody on the phone for a fair amount of time here. We thank you all for your time. Just to open it up to the group, on the acquisition front, what are you guys looking for? What do you believe you'll be target acquisitions this year? Are you going to be a net buyer, net seller in general? How do you just feel that the overall market will be for you and your group? Ryan Cockerill, we already know you're probably going to spend another $1.5 billion. So congratulations. But just to open it up to the group before we close it out. Mark?
Well, I'm happy to jump in. We feel lucky that we did our big sales program a couple of years ago at this point, so we don't have any real need to sell, and we expect that it's going to be pretty balanced from a buying and selling perspective. We are out there looking for acquisitions, and when we find them, we'll be selling assets to fund them. So it's really a bit of a chicken and the egg question. When the market feels better and people start more transacting and accepting where we see value, I think our acquisition volume will ramp up. I mean, one of the benefits that we think we'll have this year is the confluence of less aggressive lending, some of the lenders wanting to get out of debt, some of the the folks that Jim had mentioned looking to limit their exposure. And we think, given the fact we don't use debt to buy, that should give us a leg up sooner or later during the year, because the certainty of dealing with an all-cash buyer who's got $1 billion plus of liquidity sitting ready to go, we're excited about. But we also want to be opportunistic, like David said. We think we're going to be seeing 10-15% deals, cheaper deals than we did a year or 2 years ago. So we'll be patient until we find those deals that will make us some money.
For sure. I think there is huge value in the surety of closing, as David had alluded to. The private buyers have been active, but that comes with a whole nother bag of challenges on getting them to the finish line. David Wick, Phillips Edison, what are your all's kind of target marching orders on the acquisition front this year?
I think similar to Mark. I mean, we want to be opportunistic not only on the buy side but also on the sell side. I would imagine we'll be pretty close to match funding, and I think we'd like to sell as many deals as we can that aren't at that 10 to 15% discount, and buy as many as we can that are at that 10 to 15% discount. So like last year, we had a couple of 1031 buyers come to us and tell us that they want to buy specific assets of ours that we didn't necessarily want to sell, but the pricing was so good that we couldn't pass it up. So I think the hope is that there'll be some of that again this year. And in general, I think my hope is that we are more active on the transaction front than we were in 2020, and I think we will. Okay. And Ryan, as Mark has touched on, they have spun off a lot of their single tenant deals, as well as Mike Deering over at Hutton. They've obviously have had a lot of success with that program this year. Are you all finding it tougher with a flight to single tenant and the quality of single tenant and the surety of single tenant to meet your target price point and yield? How do you solve for kind of where you all need to be in the market with increasing competition in the single tenant market?
Yeah, you make a great point, Dave, that we've seen, in the tenants we're looking at, the Walmarts, the Targets, the Home Depots, the Lowe's, all the way down onto the AutoZones, O'Reilly's. And then, we do a lot of stuff in sectors I didn't mention, but, C-store that we're, strong long-term auto parts and auto service, all the net lease demand on the retail side has gone to those sectors and those tenants with term and credit. So it is more competitive. I think as we hinted on earlier, the track record, certainty of execution is still valuable out there. We get calls daily of 1031 buyers that are blowing out of deals, in the 11th hour, and hey, are you guys still interested? We offer that certainty of execution, and for everybody's match funding needs, I can lock something up for the next 60 days and pull the trigger and send out that wire whenever you need it on the other deal. But no, they're as far as what we're going to be seeing this year, that there's going to be 1031 demand. What I feel is going to happen across the net lease retail sector as the lending comes back from some of these ancillary sectors. I mean, I think the pandemic is we kind of see the light at the end of the tunnel. I think we have the tools that we need to put it in the rearview mirror. It's a matter of how much time does that take, right? Until people are vaccinated and all these retailers are open and operating, not at limited capacity, but that are profitable. And I think once we have that clarity, you're going to see that concentrated demand in the net lease sector start to level out across more of these tenants, more of these sectors that might mute the competition in the essential or necessity-based retailers, at least I hope. All that being said, we were able, I think it was an unknown in March, of how much volume we could, put out there in quality assets. We found them. I think we're bullish and think we can, there'll be the opportunity to do it again in 2021.
Thanks, Ryan. And Mike, what about you guys at Hutton? What do you guys got planned? What does the horizon look like for you for the coming year?
Well, we're starting the year, from a cash needs perspective, we're actually in pretty good shape. So there's no urgency or need for us to be selling right away, but we are going to be looking for opportunities because there is some demand still, especially on the single tenant side. And then as it relates to the shopping centers, I mean, we still absolutely want to own shopping centers, but we're really focused on trying to make that more grocery anchored specifically. So we've got some developments in the works there, and that'll continue. But then anything that's not grocery will be strategically looking to sell throughout the year as we move forward. And then, on the acquisition front, we're kind of like everybody else on the call, we're going to be looking for opportunities as well. I think where we're focused on is trying to find assets that are, 100% retail now that maybe don't need to be 100% retail going forward, to kind of leverage some of the skills that we have in developing on some of the new areas we're getting into. And that's been a pretty big focus of ours, as we're just looking for deals over the last quarter of the year and into this year. So, it's interesting, and we've done it a little bit before. We've got a project down in Florida that we're underway on. We've got 250 multifamily units set to open later this year on a site that was previously 350,000 square feet of retail, and now it's about 125,000 square feet of retail. So just looking for interesting opportunities like that. There seems to be quite a bit out there, just finding the right markets and the right opportunities.
Yeah. Well, good stuff. I mean, as Dave noted, we're running about a couple minutes over 30 minutes, and we didn't want to keep this too long. I know we're leaving a lot of issues, a lot of topics on the table here, and we'd love to follow up with some of you guys individually, maybe on some separate calls to go over some of the other issues that are right in front of us as we begin this year. But I think, as the conversation noted, I think there's going to be opportunity out there this year, and you may have to be patient for it. You may have to get creative for it, but I think everybody on this call and the people we do business with are encouraged for the year ahead, and I know that we certainly are at the Palomar Group. So good stuff, guys. It was highly informative. I appreciate you guys joining. I'd like to thank all you guys and thank those who are listening to this recording online. We want to wish everybody our very best in continuing to combat the effects of the pandemic, both physically and economically. We want to let everyone know that our team at the Palomar Group is committed to helping in any way that we can as we continue to move forward and come out of this crisis. And please remember that you can contact any member of our team at thepalomargroup.com. And once again, guys, thank you all for joining us. We'll look forward to catching up again soon.
Thank you, guys.
Thanks for your time.
Thanks, guys.